seconds. Tonight, or this afternoon, we're going to cover two of the chapters, two of the last four chapters, and what the text refers to as understanding accounting and financial information. And the first we're going to go through this evening, this afternoon, chapter 17, is understanding accounting and financial information. So, our learning goals for this chapter: demonstrate the role of accounting and financial, that financial and accounting information play for a business and its stakeholders. Identify the different disciplines within the accounting profession. List the steps in the accounting cycle. Distinguish between accounting and bookkeeping, and explain how computers are used in accounting. And explain how the major financial statements differ, and then finally demonstrate the application of ratio analysis in reporting financial information. So let's begin here with kind of a definition, if you will, of what is accounting. And as you can see on the slide, it is doing all the things needed to do with different, the word escapes me, different classifications of money and assets coming into the organization and going out. So notice it's you're writing it down. You're saying where it belongs and what type of transaction this is. Then you're coming up with a summary of what you've done, and you're making some valued judgment of what those numbers mean. And then you're going to provide that information to various and sundry parties. Now, remember, the various and sundry parties we're speaking of here are those outside the organization. When we get to managerial finance or financial management, which is chapter 18, be 50 or so minutes from now, we'll explain a little bit differently. But most of what this goes to are external stakeholders. Notice what's listed here: unions, the government, stockholders. If you're a large organization and you're a publicly traded organization, it has to go to the Securities and Exchange Commission. And then, of course, people that you owe money to or borrowed money from that you eventually owe, you must pay them back. So what this is telling those outside sources, is the financial health of the organization. So your assets should always, at a minimum, equal your liabilities. Hopefully they would be greater. Now, there's a conundrum that I want to pass along to you. I happen to see this I think in USA Today last week. And someone posed a question to this financial individual: why is it that Apple is borrowing money to finance some things that it wants to do when it has billions of dollars in assets? Now, most of those billions of dollars of assets are resting outside the United States. And the reason that Apple borrows money is because if it brought those assets back to the United States, it would have to pay tax on them. And so it doesn't want to do that. And so it borrows money to do some things that it wants to do in this country. And of course, it has more than enough money to pay back what it's borrowing. But that's one of the things I'm talking about here, borrowing. I just want to give you that little side thing, because you'll see those different things that some company is borrowing money when in fact it has billions of dollars in assets, and it's a head scratcher because it doesn't make sense to the normal person, to the everyday person who's not into finance and how companies operate and things about their financial condition. So we are now going to look at this next slide, which is not easily seen here. And you're better off looking at figure 7.1 in the text. I'll try to blow this up, but I don't think I can. Let me see what I can do here. No, it's not made it any better. I used to have a tool on the Farmer system that we use that I could blow this up. Well, maybe I can. Here, let's see here if I can blow that up any. I just found my tool. Yeah, there we go. So you can see this a little bit better, and hopefully it makes sense. You see on the left-hand side of your inputs. Remember when we talked about production, you had inputs coming into the company. The inputs went through some type of transformation process, and then we had outputs. So here on the left-hand side, we're showing all the different things that would go into different accounting classifications. Sales documents, of course, that's an asset. We're selling something. We get money back for that. Things that we're purchasing, expense reports, payroll records, travel, etc. And all that goes in, and then it goes through some processing here. We have to do some things with this. So we make entries into journals, and then the journal entries are posted and transferred to various other places, which we'll talk about here. And then we'll come out with, I'm having trouble with my camera here tonight, and then we'll come out here with different types of financial statements. And the ones that are most important are listed here: balance sheet, statement of cash flow, income statement, etc. So those are things that we're interested in, and this is simply a different way of looking at inputs being transformed, and then we're going to have some outputs. Except here, we're speaking of numbers as opposed to things. This particular slide speaks of an accountant's responsibilities. And notice a lot of this person's doing here is some guessing. Then they're doing some strategy planning, personal finance, valuation, merger, acquisition, which may or may not occur. And then for tax and auditing, this is showing a percent of things that they're supposed to do, what their responsibilities are. Of course, tax and auditing is always going to be high. Now, the next slide we come to, managerial accounting. And this gives you some information down here on the bottom of page 465. This information that has been gathered by the financial analysts, for lack of a better term, is passed on to managers, obviously folks in the executive office and the CEO, chief financial officer as well. And it helps these folks make decisions where they want to put the money, where the money has to go, where they see things that are called little notices. Hey, we have to pay attention to this. We're not doing here what we want to be doing. We need to make closer account of our expense ratio and things of that nature. And managerial decisions based upon finances are centered around the things we talk about here. How much it costs us to produce a product. And then if we look at how much it costs us to produce a product, and then how much we're buying in supplies, if you will, raw materials, we get some indication of how we're spending our money and whether or not we can make some cutbacks in some places. Now, when I use the term cutbacks, please do not think about this as skimping. we maybe need to find a different supplier who can give us better material at reduced cost, or give us better material at the same cost, and yet we can produce more. What it costs to tell our story about the products we have. And of course, then we have to prepare our budgets and make sure we have adequate safeguards to control the money that's there. And then obviously, the thing there that always talks about is minimizing tax liabilities. Now, the first thing that comes to anybody's mind when they see that statement down there is cheating Uncle Sam. And that really is not the purpose of that. What this means to you, or should mean to you, is that there are things that you can do with the money. You can move the money around in certain ways to your best advantage, to take advantage, to your best advantage, and then take advantage of the opportunities that the government allows you to reduce your taxes. I suspect we're going to hopefully, I should say suspect, I shouldn't say suspect, I should have started with hopefully. Hopefully we'll see some resolution this year on our tax structure in the United States. It's entirely too complicated. Now, I'm not an accountant. I don't have that kind of knowledge. I know pluses and minuses and things of that nature. But our tax structure is too complicated. And I say I hope, because if we get past August or September, we're not going to be able to do that, because those folks are going to now be in the chomping at the bit for the next election cycle, presidential election cycle, which, as you know, is beginning today. But it'll take on a greater emphasis as we get to the end of August. And of course, Congress is on sabbatical, for lack of a better term, in August. Rarely meets in August. That's almost tradition. So they'll come back in September and may have to grapple with a budget, and then they'll want to get out the door and start preparing for the 2016 campaign. Now, this particular slide, I'll get up here and get the video back so I can talk directly to you. This particular slide shows the users of accounting information. We talked about these before, so I'm not going to get into them a whole lot. But you notice there are two things here. Number one, what the government wants. It wants the tax report. But then the regulatory agencies, I mentioned the SEC, Securities and Exchange Commission, there are other ones that have required reports, and those things are necessary to get to them. Most of those happen to be quarterly reports, and especially for companies that are publicly traded. So you can do that. And then, of course, we want to make sure that the financial statements are distributed throughout the firm to those people who most need them. Now, you remember, New Belgium Brewery, the video we saw about that, Chapter 8, or associated with Chapter 8, and they focus on transparency. And so they have what they call open books management. Everybody can see the financials for the company. Now, two reasons for that. Again, the transparency. The second reason is that the organization has people become stockholders after they've been employed a year. So obviously stockholders want to see financial information. How well that would work in a large organization, I don't know. But everybody really ought to know some kind of financials and what things were going on. They're reported to us here usually on a quarterly, well, not a quarterly basis, but anyway, semi-annual. We get some kind of idea of where we stand financially. And of course, for a nonprofit like we are, that's very important. Not that it's not important for anybody else, but people need to know that. They need to have some kind of an understanding of the firm's condition. Now, here again is another slide to financial accounting. These are things that we tell those folks outside of the company, and because they are interested, and many of them have a vested interest, and they want to know whether or not the company is making any money. And they want to know if it's able to pay what it owes, And finally, and this is very important, they want to know how much a company owes. Because if a company owes too much money and doesn't have enough assets coming in, it's going to be perpetually in debt. As I mentioned before, companies borrow money because, if they do certain things in borrowing, they can take the interest off and things of that nature. So it's more beneficial to them, but pardon me, in the long run, to have creditors, but you don't want to have too many creditors. Now, the next thing we need to know is how are we going to be able to read this financial report? In many cases, to a lot of people, numbers are just that, numbers. And so there has to be a couple of things. First of all, the numbers have to be meaningful. So there has to be something it tells you in some manner what you're looking at. And then you have to have trust in the people who are reporting these numbers. Because there's an old statement that figures don't lie, but liars figure. Now, I'm not trying to say anything here, but this is a trust situation. So here's what you want to look for. You want to look at the balance sheet because that tells us where we are. You want to look at the income statement because that tells us whether or not we're making any money. We got more income than we have outgo. And this next thing tells us how the money's coming in, how it's going out, how we're doing with our creditors, et cetera, et cetera. And the final thing, and this is very, very, very important, it's the auditor's opinion of the financial health of the organization. Now, this is where we really get to some dicey things and some things that happened, and we saw this in the Enron implosion in 2001 and some other things. Auditors are supposed to be independent, but you must ask yourself a question. If a company hires your firm to audit them, how independent are you because they're paying your bill? So there has to be some line of demarcation set that gives the auditor free rein. And what was happening at Enron with the Arthur Andersen was their auditor. They had folks there doing an audit, but they also had folks working for Arthur Andersen who were consultants. And the consultants were telling Enron what they were doing was okay. The auditors somehow were kept in the dark about that. And had they known that, they would never have said that Enron was in good financial condition, which they did. So it's very important that the auditor who is hired has freedom to do whatever it is the auditing company needs to do. If they're restricted, then they're really no longer independent. So it's very important that those things be scrutinized, those contracts be properly written and properly carried out, because the accountant is being paid by that company, but it still needs to have a free and unfettered access. And so I was involved in that when I was with a small nonprofit company, and we would come in and the auditors would ask, we need these things and something else. And we made them available to them. And we needed the auditor to be able to go back to the people, but our people who were funders and people who contributed have a good idea. Our statement was posted on the website. We had to be able to tell the state of Ohio that we were doing the things we were supposed to be doing. Now this gives us an idea of public versus private accounting. By the way, I do want to point one thing out to you. The users and types reports, which we saw here before, and slide number 10, we're on 13, can be seen in the text figure 17.2. So here we have different types of accountants: private accountants, public, certified public accountants. a private accountant normally works for one firm, and he or she does not offer their services to other organizations, whereas a public accountant does that. Notice the public accountant works for pardon me, individuals and organizations. A certified public accountant is an individual who has, number one, and let's just talk about the state of Ohio, holds a bachelor's degree, has approximately, as I remember, 24 to 30 hours extra coursework, college coursework over and above the requirements for a bachelor's degree. And then he or she has taken a test or examination, better word, by this American Institute of Certified Public Accountants, and then meets whatever other state requirements there happen to be. Most state requirements are in about the line that I talked to you about what Ohio is, 24 to 30 hours college coursework in addition to the requirements for a bachelor's degree. Most of that is usually is in accounting. The test that is examination that is underwritten by lack of a better term, by the American Institute of Certified Public Accountants is very difficult. A lot of people do not pass it the first go around. And I think you're allowed to take it up to 3 times before you either can't take it again or you have to go back and get additional schooling of some kind. Now, this particular slide just talks about ways to improve accounting practices. The largest one here is to either create or expand the internal audits. Now, an internal audit, we often think of an internal audit as being focused on dollars. And of course it is in some respects, but an audit can be a lot of things. It can look at production practices, can look at things such as purchasing raw material and things of that nature. So there's a lot that goes into auditing, excuse me, and not just dollars and cents. There are other things. And then hire an independent firm for consulting. Now remember, go back to my last statement. You hire a firm. Who does the firm work for? It works for the company that hired it. So the company needs to make sure through its board of directors, and if we're talking about a publicly traded organization, through its board of directors, that there's nothing off limits. You see anything you need to see and go through that procedure. The object of having an outside auditor or an accountant is that that person is not beholden to anybody, and he or she can, and the team, usually a team, can do assessment as they need to. And so it's very important. There has to be a good working relationship between the company that hires and the auditing firm, accounting firm. Some do both, and to make sure that what is being reported is accurate. Now we'll look at some other things here. This is the Dodd-Frank Act that was passed in response to the financial meltdown that we had here in the United States that began in late 2007, mushroomed in 2008 and 2009, that we are on a whole about crawling out of that morass. I say on a whole, the economy, as you know, the macro economy is doing well. Look at the stock market and a few other things. But many individuals don't think they've recovered. They either, let's go back, take that apart again. They either have not recovered or don't think they've recovered. Of course, they don't think they've recovered. As far as they're concerned, they haven't recovered. I understand that. I'm not trying to gloss over this. So what the Dodd-Frank Act was done, what the Dodd-Frank Act was supposed to do was to increase the powers of the Federal oversight commissions and committees, which would be the Securities and Exchange Commission, FDIC, Federal Banking Deposit Insurance Corporation, and organizations such as that. What we have found is that as the economy has improved, at least at the macro level, we've had more and more institutions trying to chip away at the oversight that Dodd-Frank was designed to implement. And we seem to run a yin and yang in this country of a boom, financial boom of some kind, and then we've run into some type of recession. Now that's a normal cycle. But when it gets to extremes like our Great Recession did, which was probably very similar to our Great Depression, then we get a lot more on the regulatory aspect. We never can seem to get a balance. The regulatory aspect here is supposed to hopefully protect people like you and me, individual investors. If we put money in banks or savings and loan or credit unions, we may invest in mutual funds or stocks or something of that nature. Certainly not like the big boys do, the big institutions like CalPERS from California Personal Retirement System, and places like that. We don't have megabucks like those folks do. We also don't have megabucks like some industries do, and some people in those industries that can influence the stock market, by the drop of a hat or a wink of an eye, like Warren Buffett. And I'm not saying bad about Warren Buffett. I'm just using him as an example. Regulatory practices, laws, were put there, enacted, signed by the president to protect the average person. And also to tell banks and other institutions, you have to play by the rules. And part of the problem about playing by the rules is that a lot of times people will come into their superiors in these financial institutions and say, we can make money this way. And the person who's in charge doesn't know enough about what they're talking about to say, wait a minute, this doesn't pass the smell test. It doesn't pass the common sense test. And he goes on, and that's part of what happened with these collateralized mortgages and things of that nature. The people that should have known better didn't, and part of it was because of ignorance. And not that they're stupid people, they just didn't understand. And a lot of people didn't understand. And so that's what got us where we are. So we need the regulation. But right now, since things are getting better, the banks want to do away with a lot of this regulation. The only way to stop that is to tell your members of Congress and senators, excuse me, I went backwards instead of going forwards, and what it is that needs to be done. All right, now these are people who do different, various sundry things, tax accountants. These people know the tax law. They have to. That's what their job entails. And many of those folks help you with your individual tax returns. And at government and not-for-profit accounting, really the same kind of thing. But you'll notice when you see the video for Goodwill, why they focus so much on financial accounting statements. They're really needed. No nonprofit is in business to make money, but many of the nonprofits, quote unquote, businesses within the business do make money, and that helps them fund other operations that don't make any money. So besides the people who donate to them and grants that they may get and things of that nature. So they have to have a budget, and nonprofits have to report their financial standing every year to the state in which they reside. And so that's very important that be done correctly. Now we're going to talk here about the accounting cycle, and that is graphically displayed in your text at the bottom of page 470. in figure 17.4. Let's blow this up here a little bit so we can see it. And the first thing we're going to go through is, notice it's a 6-step process. And we're going to analyze or see where these documents come from and what they happen to be. Then we're going to make a record of them. We're going to transfer what we've done, the post entries, to a ledger. Then we'll do what's known as taking a trial balance. These are the 3 major things here at the end. Prepare the financial statements, which is, from the financial statements, we have the balance sheet, the income statement, and the statement of cash flows, and then we're going to make an analysis. So we're analyzing at the beginning and we're analyzing at the end. And the analysis at the beginning is, where does these figures go? You know, is it to the marketing budget? Is it to production? Is it to sales? Is it to expenses? Is it to something else? And so then we're going to come up with this figure at the end. Now, the next thing we're going to talk about here is the bookkeeper's role. And notice what the bookkeeper is doing here. He or she, or maybe a team, is putting the transactions, as it says, into what it says a meaningful category. I would like to say they're actually putting them in places where they belong. And then they're going to make a record of that. Of course, you know, years ago it was done by stubby pencil. Today it's done with a computer for the most part, or a computer and a computer program. It's going to go into the record, and that's known as a journal. Then we have something that is known as double entry bookkeeping. By the way, this process, double entry bookkeeping, has been around a very, very long time. It's not new. All transactions are recorded in 2 places. That's a check and balance. That's exactly what it is, to make sure the figure is accurate. Very, very important. And then here's what the accountants, bookkeepers use. They use a ledger. And then, again, they'll do this trial balance, which is, notice here, it summarizes the information in the account ledgers to see where the company stands on a specific, at a specific time. Could be day, could be week, could be month, could be quarter. And some of it's done all along. Some is not done all along, depending upon the size of the company. And notice it says the ledgers are specialized accounting book, normally now done with a computer program. And here are some computer programs that are mentioned here, especially for small companies, QuickBooks and Peachtree. So it's a little bit better than doing stubby pencil. Excuse me. Now here are our financial statements. And remember, the 3 key pieces we're looking for, or the 3 key answers probably is what we're looking for here, is the balance sheet, the income statement, and the statement of cash flow. Those tell us, after we've done those 3 on the input side, those tell us where we stand at a particular time. And this is what is known, very simple here, with nothing here that's mysterious. This is the fundamental accounting equation. And it's, notice here, it's the balance of the, it's the, excuse me, the basis of the balance sheet. We come down here to the bottom. Assets equal liabilities plus the owner's equity. That's always the way it is. So it's what we have equals our liabilities plus the owner's equity. So the owner's equity could be whatever he or she was over and above what these assets are. The assets belong to the organization. The balance sheet is exactly what it says. It tells us where we stand. And just think of this as a scale. If it's too much on this left-hand side, we're underwater. So we want it to be at least here, preferably here. And again, at a specific time. Now this is assets, and I think a lot of times we don't think about assets in a proper manner. Assets are anything that the firm owns that are either tangible, something we can hold, or intangible, something that we can't hold. Now, for instance, if you're a large company and you have a brand, what is the brand worth? And we went through some of that last week with Coke and Apple and a few of those people. Liquidity means how quickly we can turn our assets into cash. Now, we have to classify assets. All assets are not equal in classification. Current assets means something we can turn to cash in less than a year. Fixed assets, these are things that are around for a while and they're permanent. They're different. Their value, for the most part, does not increase. Yes, I know property value can go up, and so that would make it true. But if you have a building over a period of time is not going to maintain its current asset because it ages, the replacement value goes up, and things of that nature. Equipment is the same thing. Equipment has, especially major equipment, has the depreciation value. And there's a schedule put out to how you can depreciate the value of those things. So if you bring a brand new piece of machinery in today, it's not going to be worth the same tomorrow because it's already been used. All right. Now, we classified assets, so we have to classify liabilities. And the first is what we owe. That's pretty simple. We don't have to clean that up any or dance around it or anything else. What do we owe? An account payable. That's what we owe because we purchased something and have yet to pay for it, or we purchased it on credit. A little bit different thing. If some people would dice that a little better than I do because they're more into accounting than I am. But if it's something we bought, we normally pay for in 30 days. That's really not, to me, that's not credit. I think maybe in some cases it's considered a credit. Notes payable, that would be our short-term debts, bonds, or something else we had to do. And well, first is note payable. That's a little bit different than bonds, as you know. And then the bond is long-term. You look at the notes payable, something we went to the bank and borrowed money from. And we'll get a little bit more of that when we get later on here. Not necessarily this week, but certainly next week. Owner's equity is something we always need to talk about because it's not always easily understood. Notice here, it's what belongs to the business. The amount of the business that belongs to the owner or owners minus liabilities. So remember we talked about that before. So it's what it meant, how it went. Retained earnings, this is something we keep within the company. We don't pass it out as a stock dividend. And it is reinvested in some fashion in the company. We may buy more equipment, we may buy more something else. We may just hold on to the money. Somehow it's reinvested into the business, and there's nothing that's paid out in the way of dividends. Income statement. Again, something that we need to know about, and it just tells us where we are. Profit after costs, expenses, and taxes. Now we want that to be at least even, preferably on the plus side. Now there are some times that companies will take what's known as write-offs because that's something that they need to do. They're writing themselves of a business or some type of asset, and so they'll take a write-off and may have a negative quarter, but they don't want to have a negative annual report. And it's something that's very, very serious. So here we're down to the bottom line here, this income statement, telling us where we are. Net income or net loss. It's what we have left after our costs and taxes. And notice I did not use the word profit. What we have left after costs have been deducted and we paid other expenses, taxes I'm putting in here. So that's what we have. That's we're either going to be on the plus side or the minus side. Well, of course we could break even, but we have to know that. And then here's the income statement once again, and there's a formula for this. Revenue is the cost of goods sold minus cost of goods sold equals gross profit. Operating, I want to read these to you because it's important to get them down. Operating expenses equal net income before taxes minus taxes equal net income or net loss. So here it is. Revenue minus the cost of goods sold equals gross profit. Then operating expenses, gross profit, minus operating expenses equals net income before taxes, and then minus taxes tells us whether we made or lost money. Now here's what revenue is what we receive. Remember, it's what we receive from goods sold and services rendered and things of that nature. So cost of goods sold, either what we sold because we buy something and sell it, or what we made, measures what it cost us, measures the cost of merchandise the firm sells or the cost of raw materials. And then gross profit or gross margin, how much we earn by buying or making and selling the merchandise. Again, gross. We're not taking anything out of it. So it says $150,000. It's $150,000. Now it's $150,000 minus something, perhaps. It may not always be true, but we have to make sure that we take care of that deduction. Now, we're still going on here. Operating expenses and depreciation. What's it cost us to operate? What's it cost us to operating expenses? What's it cost us to turn our lights on? What does it cost us to pay our salaries, wages, and benefits? Those are all operating costs. Depreciation, and notice I said before there's a way equipment is depreciated. It's on a scale. Now, companies are allowed to do some depreciation differences as long as they don't depreciate longer than the useful life of the machinery. That they could say, in other words, the normal useful life of the machinery is 8 years. They could say, what we're going to do, we're going to extend it to 10 years, and that's okay. But they can't take off any more money. So depreciation, what it says here, over estimated useful life. Statement of cash flows, just tell you what's coming in, what's going out. And here's what goes on with these: operations, investments, and financing. Now, it's okay to do this cash flow, but we need to understand it. And it's not really too much different. It's just the difference between what comes in and what goes out. And we have to be able to manage cash flow. We have to know where it is. We have to know what's coming in and going out. And notice at the bottom, it's especially challenging for a small business, and it's challenging doubly for a small business when it comes to seasonal businesses. Most of you know, or if you don't know, you should know, that retailers earn about 50% of the money that they do all year long during the holiday season. So it's very important for a small business to really manage that cash flow before you get to the holiday season, and then doubly so once they're there. Now, these are the ratios that go through. The ratios kind of tell you what your financial status is. Firm's financial condition using calculations and financial ratios. And there's four that are very important: liquidity, leverage, performance, and activity. Two key ratios are the current ratio and the asset test. And this is found on the balance sheet, so it's important to know about these. Leverage just tells us how much we rely on borrowed funds. That's leverage. Key ratio here is the debt to owner's equity, and again, found on the balance sheet. Probability ratio. That should be pretty easy for us to figure out just with the words that are there. How effectively we're using the various resources that we have to earn a profit. And here we use basic earnings ratio per share, return on sales, then return on equity. Again, found on the balance sheet. Activity ratio, again, something that we ought to be able to figure out from what it says to us. How effectively we're turning over inventory. Very important. And then the inventory turnover ratio is what we would use. Again, found on the balance sheet, but also on the income statement. That's one of the things we'll look at when we look at Hard Rock Cafe. In that, not a video, but it's a case study that we use. This is the Accountants of the World United. There's some interesting information here that countries have adopted what's known as International Finance Reporting Standards. They want to make those standard across the world. Now, of course, not necessarily all countries will be into that, but certainly the developed countries would be. And the Securities and Exchange Commission believes there ought to be such a standard. Whether there's going to be one or not, I don't know. It's certainly something that needs to be accounted for. And then here's the timeline for this. I have not read anything that tells us now we're past 2014 if large public companies will be required to report in the International Finance Reporting System. SEC is supposed to make a decision. Again, I've not seen that they have or read that they haven't. Again, companies will be required to report in IFRS. Again, that's pending a Securities and Exchange Commission decision. We have reached the 5:21. We've been at this for 50 minutes, and it's time for us to take a break for me to stop talking for a while. We'll come back at 5:26 and talk about managerial finance. Thank you. Please come back at 5:26. Goodness, thank you. All right. We're back for our second hour this evening, Chapter 18, Financial Management, often referred to as Managerial Finance. I just did that a while ago. Don't be confused. The two terms are used interchangeably and they mean the same thing. But since the text correctly calls it financial management, that's what we'll stick with. Our learning goals for this chapter are to explain the role and responsibilities of financial managers, outline the financial planning process, and explain the three key budgets in the financial plan. Now, these budgets, we're not now talking about cash flow, income statement, and things of that nature. We're talking now about budgets. Not that we've forgotten those, but we now have other issues to think about. Explain why firms need operating funds, identify and describe different sources of short-term financing, and then identify and describe different sources of long-term financing. All right. Now the question that's posed here is, what is finance? Pardon me, let me get this picture up here synchronized with what we're doing. Finance in any firm is that part of the firm or those people engaged in doing certain things for the company that acquires funds and then manages those funds. They go out and get funds somehow, some way. Now, that's not nefarious. I mean, they're going to do this legally, hopefully. And then they're going to make sure that those funds are managed so they know where they are and how they can be used and put to use. Now, within the financial activities, now this is beyond financial accounting we talked about in the last hour. This is managing finances. These people prepare budgets. Notice they create cash flow analyses. They don't tell about the cash flow. They don't come up with the cash flow statement, but they analyze that. And then they have some kind of plan for expenditures. Now, that all comes from preparing budgets, and the budgets are outlaid, and they tell you what they're going to do and how they're going to do it, et cetera, et cetera. Of course, given that the fact that we have adequate resources to do what it is that we plan to do. Now, financial management is simply managing what we have. Now, it says here, managing a firm's resources to meet its mission, goals, and objectives. I would counter with that in saying that they don't really manage the human resources, employees. They will certainly tell human resource management and upper management, of course, these folks are usually at the table, to say we either do or do not have resources to support our current staffing levels. So in that fashion, financial managers do have some handle over managing a firm's human resources, employees. And we do need to think of it in that fashion. We cannot dismiss that. They're going to tell the folks that are in charge of recruiting, selection, and things of that nature, yes, we do have enough money to maintain current staffing levels, or no, we do not have enough money to maintain current staffing levels, and we have to have a freeze on hiring. Our next topic is financial managers. And of course, these are the folks who do the things that we just talked about. They're the folks that put these things into operation. And these are the things that financial managers do. They pay the bills, and they have someone collecting money that comes in. Now, most large firms don't really do that. That's the normal give and take of any type of operation. And most successful smaller firms don't do that either. But they have people who are recalcitrant. They don't want to do the things they're required to do. They don't want to pay on time, or they don't want to do some other type things. So there has to be somebody who has to act as a hatchet person, if you will, to get the money coming in. Notice this next thing talks about, and this is a big issue even today, talking about staying up abreast of what's going on in the marketplace. It pretty much means the financial markets and the stock markets. Maybe I should just change that and say securities markets, which will certainly include bonds and stocks and things of that nature. This thing is very aggravating tonight. Won't stay out of my way, and every time I touch it, then the picture goes away. And for instance, we have had volatility in the oil and the petroleum industry. Volatility meaning that prices have gone down exceedingly. Well, I think we've seen the bottom. It appears that gasoline prices are on the way back up. We should have liked what we saw for the period of time we saw it and taken some advantage of it to our own best interest. And that's what companies have to do in this particular situation. This is to our advantage to buy petroleum products now when they're down as opposed to waiting later. And so that's what we're talking about. And then the last that's noticed there is assuring accounting accuracy. This is just a gee whiz slide, like I like to say often. Who's in finance? Who's in the finance? Certified chief financial officer for companies. Now, some companies may have certified financial planners or chartered financial analysts, etc. Most large companies will have a comptroller. That person's noticed the chief accounting officer. But some firms may not have those either. Those two there in the middle. Now, here's what the financial managers do, and you can see this graphically displayed in your text, figure 18.1 on page 495. And we've talked about some of this, but some of these things we have not talked about a lot. And one is planning. One's giving advice to top management. Obviously, the other things we have talked about: controlling funds, getting funds, managing taxes, auditing, etc. Well, here's a slide that says what worries financial managers. Notice the top one there. They're concerned whether or not the buying public is going to continue to want the firm's products. It doesn't really talk at the first about money. It talks about we're still going to be able to sell. And then, of course, credit rates and the next one that way down there should be really high up, especially for large companies. And that's the evaluation, the fluctuation of the dollar. The dollar is very strong right now, which means that our exports, we're not exporting as much, or if we are exporting as much, which I don't think we are because of the stronger dollar, people in foreign countries won't be buying as many American products. Give you an idea of the dollar being stronger. About 3 months ago, maybe 4 months ago, it took about $1.35 or so, probably maybe a little bit higher than that, to buy €1. Today, that's about $1.14. It may have gone up some today. I'm not really too sure, but that's a 20+ cents difference. And so stronger dollar is good for us. Americans here that because that means anything coming into the country is going to be less expensive based upon the strength of our dollar. But it's not good for our people who are exporting. Procter & Gamble, for instance. By the way, a little disclaimer here, I do not own Procter & Gamble stock, but I can speak about Procter & Gamble pretty easily because it's a Cincinnati company. It's a Fortune 500 company, and it's been around for a long period of time. And it's virtually every place when people are into cleaning products and things of that nature. It's not, I don't remember whether sales were down, but profits were down because of the stronger dollar. And of course, sales could have been down as well. Now, you can see this particular slide, the things about this particular slide on the bottom of page 495. Companies fail because they don't have enough money. They aren't sure where their money goes, and they don't control expenses. There has to be some thought about that, controlling expenses, because that's one thing that a company can really improve upon through various and sundry means and methods. So, I mean, of course, the other thing those other things are just as important, but they can certainly do a lot of control, and it's very necessary that they do that type of control. Now, these are concerns by the chief financial officer, CFOs, on a macro level, big scale level. Whether or not people are going to still want the product, kind of going back to what we talked about before. Are the government's policies intrusive? In other words, are they free and unfettered? They allow us to do things we want to do. Of course, there has to be some control, and we try to do it, but we have to be careful about having too much policy, procedure, regulation, and law that stifles competitiveness. How much do we have to compete with those folks who are in our industry? Do we have to match them dollar for dollar? We have to be concerned about that. Or can we continue doing what we're doing because we have a quality product? We have to be concerned about how much it's going to cost us to do business if we need to borrow money. And we always have to be concerned about the global market and its instability. And that's always the thing that we have to be concerned about because we just don't know about the different things that we talked about. We just don't know about instability. Some countries are really causing lots of problems, and that affects our trade and other things. Now, on the micro level, are we able to continue doing what we're doing and still earn the same percentage of profit? Are we able to maintain high employee morale? And obviously, if we do that, then high productivity. A big one, what's it going to cost us to continue the benefit of healthcare? Now, a lot of people say, I don't know about this, I just want to give you this as a piece of information. There's a lot of people say that if the Affordable Care Act is not gutted, for lack of a better term, through this suit that's the Supreme Court's going to hear, the case Supreme Court's going to hear a little bit later this year, and probably won't give us a decision until the end of June. Now, whenever the court has momentous decisions, it waits until the last possible moment. So the last possible moment for the court this year will either come on the 29th of June or the 30th of June, Monday and Tuesday, the last 2 days the court's in session. Then the court goes on recess July, August, and September, and comes back the first Monday in October. Now, when it goes on recess, that doesn't mean it's not going to do some work. What it means is it's not going to actively hear cases. It uses that time to decide which cases it's going to take to decide in the following term. So anyway, a lot of people believe that if the Affordable Care Act is maintained and it gets stronger as the years go by, that fewer and fewer companies will offer health care. I don't know whether that's good or bad. I think if I'm being an optimist or trying to be an optimist, I think it would probably be good. It certainly would be good for companies. It would give them more money to operate with. And it may be good for consumers if they are able to get the type of coverage that they need and not too much of it's out of pocket. So how that's going to happen, I don't know. This is not inconsistent with what we've done. You know, for many years, we had what pension plans were known as defined benefits. You work for a company for so many years, you attain this level of position within the company, and the company had some kind of actuarial figure, and when you retired, you got X number of dollars a month for the remainder of your life or for some longer period of time. That's changed to what's known as the defined contribution, for the most part, defined contribution plan, where you, Mr. or Miss Employee, contributed to your own retirement. If company is large enough, companies will match what you put in up to X%. And there is a cap on that. I won't try to tell you what the cap is. I'm not sure that I know. And many companies try to steer you into buying their stock. Well, that's all well and good if the stock goes up, but if the stock goes the other way, there's a lot of problems. And the best thing I can tell anybody, if they're in a defined contribution plan, is to diversify. You don't ever want to put all your eggs in one basket. So yeah, there's some pluses and minuses to that too. And of course, if you get into these, things are individual retirement accounts, what they normally are, there's a tax benefit to that. And the benefit is that what you put in is not taxed. And so you don't pay any tax on that until you retire and start taking your money out. And you must do that whether you have an individual retirement account, not with your company, or a 403B account, that's 401k, or a 403B account if you work for a nonprofit. You must begin taking those out at age 70 and a half. You don't have a choice on that. Now, if you have what's known as a Roth IRA, there is no tax, ever, never, never, and you can take it out whenever you wish. You don't have to wait to 70 and a half. I mean, you can wait longer if you wish. But those are individuals that are not associated with a company. Financial planning. Now, notice here what we're going to talk about is making sure we have the pipeline open. The pipeline is open two ways for us to get the money we need, obviously through sales and things of that nature, or from borrowing, and to have the outflow so we can pay our expenses. So here's what financial planning has to do. It has to forecast financial needs, both short-term and long-term. There have to be budgets developed to handle those needs. And then finally, there have to be financial controls be put in place to make sure we're doing what we say we're doing and what we want to do. Now, financial forecasting is a little bit better than just saying, oh, well, we're going to get the crystal ball out and see what it is we can come up with. Short term tells us what's going to be coming in and what it's going to cost us, operating costs and expenses for a year or less. Then we have cash flow forecast. Usually the cash flow predicts income and outgo for shorter periods of time, months or quarters. And then long-term forecasting says what our needs are going to be in excess of 1 year normally as far out as 5 years, and sometimes you'll see them as far out as 10 years. Now, we're going to get to this as forecasting, and part of the forecasting goes hand in hand. We're going to have to develop some type of a budget. And this just tells, again, is giving us, this is like a roadmap in a way. It tells us what we expect to come in. It tells us what we expect to go out. And then we have to have an accurate balance sheet because the budgets are developed off of the balance sheet, income statement, and statement of cash flow for both our long-term and short-term needs. And notice here it says, it making my point here. I said blueprint. I said roadmap. I used one of those too. I couldn't remember which one. It says it's a guide. Well, that's what a roadmap is. That's what a blueprint is. You know, roadmap. Of course, today we probably don't use roadmaps because most every car that I know built since I don't know what 2006 or 7, maybe even further back, has a GPS in it. And you tell the genie in the GPS where you want to go, and the genie tells you, hey, take this route and that route and some other route, and tells you, well, here's your destination. Turn your engine off. You're where you want to be. So it tells us what we want to do and how we want to do it with our financial operations, and then how much we expect to need in the way of financing. Now, we have 3 types of budgets. And the first one we see here is the capital budget, and it is the most important because it ties everything together. Excuse me, I made a mistake. That's the operating budget, the master budget down below. Capital budget's big ticket items. I apologize for that. I do that quite frequently, and I'm wrong every time I do it. And it tells us what we need to think about spending on major pieces of equipment and things of that nature, because there's a large outgo for this. So that's a capital budget. The cash budget talks about what's coming in, what's going out. Again, remember, this tends to be a shorter period of time, usually a month and a quarter. And you'll have both of that. So you'll have, we're in a quarter right now. And our quarter is January, February, and March. So we would have our cash flow budget for our cash budget for January, and we would report what that is. We would do it for February, we would do it for March, and then we'd have a quarterly report. So look at the quarterly report as being a summary of what we've done in the last 90 plus days. Actually, this year it is 90 days, 31, 31, and 28. And then the operating budget is the master budget. That's what ties everything together. And it tells us kind of in a nutshell what we're going to do and how these other budgets are set and how we expect to spend if we're going to spend, and how we're going to save if we have to, if we are going to be able to save, and what we're doing and how we're doing it, how often, etc. You can see this slide here in figure 18.2 at the bottom of page 497. And it shows us up here at the top our financial plan. And then, if you will, the operating budget is in the middle. And then what revolves around the operating budget, although this is not done in a circle, but you could see it as a circle. Long-term, short-term, long-term, short-term, capital budget, cash budget, and then the financial controls. And look what we have going here throughout the entire rectangle now, and that's feedback. So we have these budgets and we're implementing them and we're trying to control them down here at the bottom. At the same time, we're providing information in the guise of feedback. That's not, don't think of, I'm talking about that being covered up in the guise of feedback about what it is we've learned, that we've done, how we're being able to control what we need to control, and things of that nature. So we need to look at these things as being interlocking. I'm using a circle more than what we see here, which is mostly a rectangle. It could be a square. I haven't tried to measure that. But it's very interesting that each of these parts is interrelated in some fashion. There's none out here that are by themselves. Now, this slide tells us about factors used in assessing financial control. Are we meeting our obligations? I think that's the first way to say that. I think it uses the term commitments, and does, but obligations are the same thing. Are we making enough money? And when I say making enough money, here we're using the term profit. So are we getting a good return from our assets? How are we financing our assets? Whether we're going into debt or we're doing something else, and we'll get to that shortly. And are the firm's owners receiving acceptable rate of return for their investment? Publicly traded company or stockholders getting a benefit. Now, every company does not pay dividends, but those that are being paid dividends are the stockholder getting a good return on his or her investment. Conversely, you could say, is the stock rising well enough that when the investor decides he or she wants to get out, are they going to get a good return from their investment? So, if you invest $1,000 and you have it there for 10 years and you decide you want to get out, are you going to get more than $1,005 back? What's a good rate of return? You have to stop and figure that out. Now, the following gives us what are known as key needs for keeping the firm operating. It has to be able to manage operations day by day. It has to be able to control the amount of money it's borrowing, credit. It has to be able to get what it needs to be able to sell. Now, inventory to make product or inventory to come in to sell product doesn't make any difference, but are you able to do that? And then, can you make capital expenditures? Now, this particular slide went too far here, I think. Hold on just a second. Yeah, here we are. How small firms can improve their cash flow. Now, the reason we're talking here about this, I have to talk when we get into financial management. We have to talk about large corporations, because a lot of what we get here and what we see in these last 4 chapters, especially 17, 18, and 19, and not so much 20, but certainly those first 3, because 20 talks about the Federal Reserve and gives us some history and things of that nature. These first 3, a lot of what we talk about kind of implies big corporations. But small companies, that's what we're talking about, understanding business. Let's focus in this course is on small business. And there are many more small businesses in the United States than there are large businesses. We know that as a fact. But one of the things that kills small businesses or makes them scramble is the fact that they do not have good control over their finances, good control over cash flow, and how they can improve that. And one of the first bullet up here says to be more aggressive and going after your accounts payable. And so what you can do, as the second bullet says, points out, is offer a discount. You might offer a discount for cash. And so if your invoice, for instance, is net 30 days, which means you expect the customer to pay you back in 30 days exactly what the invoice says. So if it was $100, you expect them to pay $100 back. Well, if you decide that you want your money a little quicker than that, you might say 2% in 10 days. So they're not going to save a lot of money, but they're going to save some money. And if you wanted to do that, then they're going to take advantage of that. You're going to have your money back. Now, yes, you're not going to have as much money, but you're going to have money back quicker. You'll be able to reinvest that money quicker. You'll be able to purchase new product or new inventory or whatever quicker. So that's a way of doing that. If you have a vendor coming to you and say, you want to buy this product, and we can give you, if you buy today, we can give you 10% off or whatever that happens to be, take advantage of that. Because if you can take advantage of what the vendor gives you and still sell at the price that you've been selling, you're obviously going to make a higher amount of money. I do not like the fourth one, raise prices. That is very, very, very difficult to do, especially for a small business. And you know, I've talked about this, but I've talked about it all along, but when we were in the marketing piece, that if many small businesses start up and they, well, I have to be able to beat other people on price, and so I set my prices low. And then I find out that I can't make enough money when I set the prices low. I can't make a profit. So now my only alternative is to raise prices. Very difficult to do. Much easier to lower prices than it is to raise prices. So yes, that's a possibility, but that's something I think should be avoided at all costs. And obviously, the next one, that goes for all of us, whether you have a business or not. Be careful using credit cards because the interest will eat your lunch and your dinner and breakfast and a few other things in between. We have two ways to raise funds for any company. One is by debt financing, the other is by equity financing. That means that you borrowed money somehow, some way, sometime, and you're going to have to pay that back. And you're going to have to pay it back with interest. And just look at that as a debt. I mean, we can't clean that up any more than that. Equity, on the other hand, is raising money from operations or through selling stock in a company. It says ownership here. I like to prefer you use things as stock, but you could sell ownership too, certainly as if you're a small company. Now, there's a danger in selling ownership. Now, I'm separating this from stock. Obviously, you know, if you own stock, you're an owner of a company, no matter how many shares you own. If you only own one, and you're talking about something like Apple, you don't have much to say. You know, it's worth a fair amount of money, but it's a lot different than somebody that owns 1,000 shares or 10,000 shares of Apple. So yeah, you could do that. You have to be careful with that, even with selling stock. And that means that if you're trying to raise money that way, the people who are into that, however you're trying to raise that money through venture capital, whatever, they're going to want their money back sometime, some way, somehow. And they think, well, let's give us a little bit more of the company. And then they can agitate other owners to throw you out, et cetera. So it's always have to be very careful about either selling ownership or selling stock. Now we know what these two are, and we've talked about these before. Short-term financing, long-term financing. Short-term financing is for a year or less. Pardon me. And long-term financing is for a year or longer. Many times, as we saw on the previous slide, longer-term financing will be up to 5 years and sometimes even as far as 10 years. Certainly, if you're selling bonds, which we're going to get to here shortly, you may have a rate of, you may have 10 years out there. So you understand that for it to be beneficial for a person to buy the bond you're selling, that it may have to be as long as 10 years. Now, this particular slide talks about why we might need some money. And we have both short-term financing, or short-term funds, and long-term funds. I'm not going to go through a lot of this for you. Long-term could be focused on new product development. Short-term cash flow problems. Obviously, if you get into that, you have other problems besides that. And there's some other ones in there that you can look at. And some of them are good. Short-term funds to expand your current inventory, and some other type things. Obviously, you're always going to have something like number 2 up there, where you have unexpected expenses. So you have to be careful about that. It should be some planning, should be some contingency thoughts here before you even decide upon what type of financing that you want. How is it we're going to, what is it we're going to need? How is it we're going to be able to overcome that? What is it is that we need to be able to do, and what are our alternatives? Now, this particular slide gives us some different types of short-term financing. Trade credit. That's just, notice what that is. That's borrowing and say we're going to pay you later, or getting merchandise and say we're going to pay you later. Buying on the cuff might be some term that you might be familiar with. I haven't used that in a long period of time, but it's something that was done for many, many years. And if you have a good relationship with your vendors, and you can show you have a history of paying back on time, they may be willing to do that. And this is what's 2 terms down that I talked about before on the outgo. Well, you could get it on the ingo, if you will. And a promissory note, that's just a contract that you have with someone. Usually it's with a bank that you intend to pay back in X number of days. Again, short term, probably 270 days or less. That's 9 months roughly. The face value plus some kind of interest. And these are ways to get short-term financing. And you can ask your family and friends. That's always a little dicey when you do something like that. A lot of people say that's a good way to lose friends, to ask for money. And of course, with your family, there's always issues with that. But if you do those things, there should be a contract written. Now, you don't have to go to a lawyer to do that. It might be advisable for you too, but you don't have to. As long as the people, we'll talk about this when we get to the bonus chapters in 2 weeks. As long as both parties are of age and they're in their right minds, etc., and they're not forced to do this by coercion or something else, then they enter into a contract. They write the contract out, they sign it, maybe have a witness or 2, and they're ready to go. And then, of course, there has to be some arrangement as how it's going to be paid back. And notice what it says here, just like you would do with a bank. So, the bank tells you, okay, we're going to loan you this amount of money. That's how you have to pay it back. Same way if you do with family and friends. And by the way, if you decide to borrow from family and friends, that's the only way it should be done, because that'll protect relationships and keep bad blood from flowing around. Things we just don't need. Banks don't like to lend to small businesses. Banks don't like to take risks, although we know the big banks during the financial crisis took all kinds of risks that most normal people would never do. But you know, the corner bank that if there's still some of those around, little city bank, country bank, they don't really like to do that. They have done it. They will do it. Often they'll do it based upon your own recognizance, but normally speaking, they don't like to do that. And so small businesses are kind of left out when it comes to getting traditional type loans. You can look through different ways to get loans if you're a small business. Here's a couple of websites that are mentioned here: Lending Club, Lendio, and obviously there's some money that has to be exchanged here. Nothing's going to be gotten free. There is no such thing as a free lunch. Never was, never will be. But these are ways to look around for them. Keeps you out of going through venture capitalists. Now, these are different types of short-term loans. A secured loan is backed by something. It talks here about collateral. Usually that collateral happens to be property. Could be your home, could be some land you own, could be something else. Unsecured, it's just on your name. There's no difference here. You just have to do that the way you're supposed to do it. A line of credit is something that's extended by a lending institution, bank or savings and loan, if the funds are available. And say, okay, you can borrow up to this amount of money. Revolving credit agreement is what it says. It's something that's there, but obviously there's a fee for it. So it's not, again, things are free. No things are free, and you have to understand that. This is something that is available to small businesses. It's what's known as factoring. Notice that it is selling accounts receivable for cash. Now, if you do that, small business, and you do that, many small businesses will do that for a number of reasons. Number one, they need the cash right away. And number two, there's some other reason. Well, I'm not going to give another one. Primarily, they need the cash right away to do something or some things. You have to understand that these folks are in the business to make money. And so they're only going to pay you a certain percent on the dollar. So if you have $1,000 cash that you want to sell, let's say, they'll say, okay, well, we'll buy that for $900, maybe even less than that. And so they will go to the people that owe you the money and say, now we bought these accounts, you owe us $1,000. So that way they would make a profit of 100. Probably it's a little bit higher than that. But it is a way for small businesses to get money right away. And it's usually because a small business can't get a loan. In some cases, banks may say, okay, what's your accounts receivable? And you can show them that you have good accounts receivable. And you can show them that people have paid you on time for a long period of time, for 2 or 3 or 4 quarters or what it happens to be. And the banks may lend you money based upon the accounts receivable. Don't count on it. Commercial paper is another one. Notice that commercial paper is unsecured promissory note in amounts of $100,000 or more, and they have to be paid back within 9 months. That loan does. Notice the next bullet. Since it's unsecured, banks are only going to get into that business with companies that are very, very, very financially stable. Well, I have to put this up because it's here. But I can tell you that using credit cards should be a last resort. Don't get into using credit cards. The credit card business will eat your lunch, and small companies, if you have a credit card in the name of the small company, may have a higher rate. I don't know that to be true. I'm just saying they may have a higher rate to pay back. So if you're going to use a credit card, obviously it's convenient, as is noticed there on the slide. Obviously, it's something that you can get right away. But you have to remember one thing, and I think a lot of us don't think about that. When we use a credit card, for whatever purpose we're using it, the credit card company is loaning us money, lending us money. And they want that back. And they want it back at the time they want it back. And if you don't pay it back, it's going to cost you money. And I remember when I was living in the Washington, D.C. area, there used to be a money program on Saturdays. And I listened to it quite frequently. And the gentleman who did that had pretty good standing. And he said at that time that if you had a $1,000 bill on a credit card and you only paid the minimum amount due each month, or you only paid the minimum amount, well, obviously each month, it would take you 8 years to pay off that $1,000 because you get paid interest, and an interest that's compounded. So be very careful about using credit cards, whether you have a business or you don't have a business, because it's not something that it is something that's available. It's tempting, but it's not the right answer. All right, so how do we raise startup capital? We can get a loan from a microloan organization. We talked about some of this back in Chapter 6 about starting your own business. We can turn to the web and seek out peer-to-peer lending. We can look at our local banks, but I can tell you if your local bank is just a branch of a big bank, don't hold your breath about getting a loan. It's probably not going to happen. That's just the way it is. I don't like having to say that, but it doesn't change things very much. You can get into some kind of relationship with vendors that want to do business with you, and that may be beneficial. You take their product, sell their product. They're going to help you in some fashion sell their product, and they can make some kind of arrangement for you. If it's beneficial, if it's to scratch your back, scratch my back type thing, something that should not be passed up. But remember, there are pluses and minuses to those things, and you really need to make sure that you know what they are. If we're going to go after long-term objectives, our long-term objectives on financing have to be in sync with the company's overarching mission, goals, and objectives. It cannot be separated. They have to be like that. They have to be close. Maybe it's better to say it. They have to be this way, interlocking. You can't have a financial plan that's at odds with the organization's mission, goals, and objectives. It's not going to work. So that it's long-term, you have to find out what you need and how you want to get there. And again, this goes back to planning, which we talked about before. Financial manager is going to, in some fashion, use the 4 functions of management: planning, organizing, leading, and controlling. If he or she doesn't, there's going to be some problems. What sources are available of long-term financing, and which is best for us? These are what the authors refer to as the 5 C's of credit. Look at that first one, character. If you don't have a good resume, I'm using that as a term now, you're not going to get any money. Now, the same thing goes for your company. If the company doesn't have a good reputation, this simply is not going to happen. Capital being invested into business by the borrower. What kind of return is that institution going to have? What's the economy? Good, bad, different? Good economy, you're probably going to get more money. Well, let's go back. Good economy, you're probably going to get money. And the better the economy is, the better terms you're going to get, maybe more money. What is it I need to be able to put up to get the capital that I want? And finally, although it's number 2 up here, I would go through those first 4 steps and then say, this guy or gal, they're going to be able to pay this money back. Long-term debt financing. Notice here it says 3 to 7 years, but may exceed 20, especially if we're talking about bonds. Loan agreement, again, promissory note. I tell you I'm going to pay you back at a certain time with interest. Now, I may work this out to paying monthly, like a mortgage, etc. Remember, the debt financing, the interest on debt financing is tax deductible. So that's why a lot of firms issue bonds, especially big firms, issue bonds because the interest they pay on the bonds is tax deductible. Debt financing by issuing bonds, indentured bond, secured bond, unsecured. We know what secured is. It's backed by some type of collateral. And then we know what unsecured is. It's only backed by me, by my reputation, how good I am. And then indentured terms is just the terms of the agreement of the bond issue, 30 years, whatever that happens to be. Now, obviously, you can, if you're a small firm, attract venture capital. We talked about this back in chapter 6. I'm always leery about giving anybody this type of advice. And the reason I am is not that venture capitalists are bad people, but it's that they're in business to make money. And they want their money when they want it. And they don't like to wait for their money. So many times small businesses don't have too much of a choice. They wind up giving part ownership or something of that nature. And I use the story of a friend of mine who is in the home security business and has been, I've known him for over 30 years, and he has been in that business for all the years that I've known him. And he's at a different venue of it now, but he and a friend that started a home security business, and they got some venture capital money, and they did very well. As a matter of fact, they had the honor of ringing a closing bell on Wall Street one day. And they start making some money and getting some profit, so on and so forth. Venture capitalists said, well, we want our money. And the only way they could pay them back was to sell the business. And not something my friend wanted to do. I didn't know his partner, but I'm sure he was in the same situation. Yeah, they made money out of it, but that wasn't what they were in the business for. They were in the business to keep a business and so on and so forth. So you have to be careful, and there has to be some kind of contract. You have to be able to live with the contract. It has to be something that both sides want. Maybe there should be an escape clause and things of that nature. Those things that you really have to look at. I can't explain those to you in hard and fast terms because they're not the same. So you have to see now there are other people that you can get. You can get people who are known as angel investors, and they're much different. And we talked about those back in chapter 6 as well. And I would say anytime that you're a small business and you have some loan issues, talk to the Small Business Administration. And those folks are there and they can give you some advice. They may not be able to give you the advice that you want, but they can certainly give you advice and they can point you in the right direction so it will be beneficial to you no matter what you do. Here's the difference between equity and debt financing. Management influence, there's none on debt financing. The bond holders cannot tell you what to do. They never become owners of the company. And of course, the debt has a maturity date. You have to usually pay it monthly installments or whatever, etc. And other things there, you have to pay the interest, and of course the benefit is the interest is tax deductible. Equity normally comes from the sale of common stock. And if you sell common stock, the common stockholders have voting rights. They can vote for the board of directors and a few other things, and then cause a friction between the board of directors and management. Notice that stock, there's no maturity. You don't have to pay that back. You never have to pay a dividend, and you never have to pay the investor back his or her original investment. But dividends are not tax deductible. And dividends are paid out after company taxes, not before. And then the stockholder has to pay tax on his or her dividend. Leverage funds, that's just raising money through increasing the firm's rate of return or getting money from employees and stockholders, but mostly employees, sometimes management and employees. I speak of employees, I mean rank and file employees. Cost of capital, it's a rate of return that you have to put out to be able to satisfy the lenders. We should all learn lessons from the Great Recession that we went through. We have had passage of sweeping financial reforms, as I mentioned when we talked about the Dodd-Frank Act. However, as I also mentioned, there are companies financial institutions that are chipping away at this. I will be very surprised if Dodd-Frank survives in its current form for a very long period of time. We have a new Congress, and the makeup of this Congress is not regulation friendly. So that's something we need to prepare for and look at and understand that the landscape may be changing. And at almost 6:24, that brings us to the end of chapters 17 and 18. We'll be back next week at the same time to discuss chapters 19 and 20, using security markets for financing and investing opportunities. And then finally, chapter 20, money, financial institutions, and the Federal Reserve. I thank you for your attendance tonight. The lecture is recorded. As soon as I'm finished here, I'll stop the recording and get it set for upload for tomorrow morning. So again, thank you. I look forward to speaking with you again next week. Good night.